You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, my co-host Sam Ball. This week on The Investor Way, we have Reckitt Benckiser, Airtel Africa, Unilever, Games Workshop, Centrica, and our US company of the week is Visa. Sam, shall I kick us off with Reckitt?
Absolutely.
So Reckitt's first half revenue rose by 6% on a like-for-like basis to £7.4 billion, with growth in all regions. All business units contributed positively, including a strong performance from the important health division. Price increases of more than 10% more than offset the 4.4% decline in volumes. Underlying operating profit fell 2.4% to £1.8 billion, ignoring the impact of exchange rates. This was largely due to higher costs from inflation squeezing margins. Free cash flow rose by £31 million to £758 million as the group focused on carefully managing production and reducing inventory levels. Net debt improved from £8.6 billion to £7.9 billion in the period. The group's reiterated its like-for-like net revenue growth target of between 3% and 5% for the full year, and underlying operating margins are now expected to be slightly above 2022 levels. And a first half dividend of 76.6 a share has been recommended, which represents a nearly 5% increase on last year. And the shares were down a couple of percent on these results. In terms of valuation, Reckitt has a market cap of £41 billion and trades at just under 17 times forward earnings, compared with a 10-year average of around 20, and has a prospective dividend yield of 3.3%. I don't think these results were terrible, but I think when we come to look at a lot of the consumer goods companies, as we do a lot on the Investor Way, Reckitt is always lagging the other companies. And we've seen high single and low double-digit numbers from a lot of these consumer good companies in terms of the revenue, or revenue growth, I should say. And with some of those really, top ones, and we're going to come on to Unilever in a minute, you're not seeing that drop off in volumes, or certainly not anymore. I think Nestle has probably been the strongest and the highest quality of those that we've covered in the last couple of years. But consistently, we're not seeing that with Reckitt. I know they've had a change at the top, and they were flattered and had sort of much better revenue than some of its peers when it came to, well, particularly the hygiene over COVID and Lysol sales, which obviously things now pulled back a lot on that. But still, I think with those brands, they should be doing better. But at the same time, they're not the very top brands anyway. So I have held Reckitt for a number of years, probably, well, let me think now, at least 5 years. And I'm at that point where I feel like I have given it a lot of time and my money might be better placed elsewhere. The share price, it's been up and down, but I'm probably about what I paid for it 5 years ago. So yeah, that's where I am with Reckitt. What do you think, Sam? I know you haven't been so bullish on it over the years.
Yeah, I don't think these results are particularly inspiring. I've always felt like Reckitt has some strong brands, but they're not in what I would consider to be the top tier of brands, where I'd put the Unilevers and the Nestles. I don't know if that's partly why they're getting a more negative reaction to the price increases with more volume drop-offs than, for example, Unilever, which we'll see later, or Nestle, which we haven't covered this week, but I'm sure we will at some point.
Oh no, I was just going to comment on those brands. They are more, I suppose, household goods, Harpic, Vanish, Airwick, Durex, Nurofen, those sorts. And maybe they, when people are squeezed, it's easier to trade down from those rather
I don't
than...
think you'd want to trade down from Durex, though. That's not something you want to compromise on.
Okay. I'll have to get the numbers up of the individual brand. But maybe with some of those, people are more inclined to, trade down.
I agree.
I don't know. Compared with like a Magnum, a Ben and Jerry's,
Yeah, Ben & Jerry's was the example I was going to use. I think it takes a lot for someone to trade down from the Ben & Jerry's, whereas if you're going from like Vanish to some like next tier that looks pretty similar and does the same thing, yeah, I think it's easier to trace down. And the other thing is when you look at the valuation, it's basically the same PE as Unilever, which is putting up better results and I think has stronger brands. And Unilever pays a higher dividend.
Yeah.
I don't want to steer you too much, but if I was you, I'd be looking at it and thinking, well, don't I want to own more Unilever?
Yeah.
You might already own enough Unilever, but well, the point is that when they're trading at the same price, why not just go for the better one?
Yeah, no, I would agree, and I do have Kraft Heinz as well, which I like, and is again is different to Unilever, and is not trading at a huge premium. So that there are lots of other companies, or the top I think really being Nestle, but that is you're paying up for that.
Yeah, I think Nestle it won't come down since we last looked at it, but it's just too expensive. It is a good business, but where was you paying, say, 17x for Unilever, 25x for Nestle, and Nestle usually puts up results that maybe like 2% better than Unilever. It's just too expensive.
Yeah, no, that's right. And the other thing with these types of companies is that you don't really need them as bond proxies now in your portfolio, where when we were in the sort of era of zero interest rates, a lot of people might have bought them for that reason, whereas now you could just buy a bond. Okay, shall we go on to Airtel Africa?
Yes, a favourite of the show.
Very much.
And a business we both proudly own. So, Airtel Africa, I'm sure by this point it needs no introduction, but they are a telecoms provider in 14 African countries. They have come out with their Q1 results, and total customer base grew by 8.8% to 143.1 million, as the penetration of mobile data and mobile money services continue to rise, driving a 22% increase in data customers to 56.8 million, and a 24.3% increase in mobile money customers to 34.3 million. Constant currency average revenue per user growth of 11.1% was largely driven by increased usage across voice, data, and mobile money. Mobile money transaction value increased by 47.2% in constant currency, with Q1 2024 annualized transaction value of 107 billion in reported currency. Revenue in constant currency grew by 20.4%, with reported currency revenues up by 9.6% to 1.377 billion, and these figures are in dollars, by the way. While each segment's reported currency revenue growth was impacted by currency devaluation, they all delivered double-digit constant currency revenue growth. Across the group, mobile money service revenue grew by 19.1% in constant currency, driven by voice revenue growth of 11.9% and data revenue growth of 29.8%. Mobile money revenue grew by 31.2% in constant currency. EBITDA increased by 22.5% in constant currency and 11.1% in reported currency to 682 million, with an EBITDA margin of 49.5%, reflecting a 69 basis point margin improvement despite inflationary cost pressures. Profit after tax was negative 151 million, and that was driven largely by a foreign exchange loss of 471 million recorded in finance costs before tax, and 317 million after tax because of the devaluation of the Nigerian naira in the month of June 2023, which we were covering another business a few weeks ago, and it touched on this, and I can't remember which business it was, but we knew this was coming, basically.
PZ Cussons.
That's it, yes. This impact has been classified as a non-operating exceptional item. CapEx is 140 million, and that's flat compared to the prior year period. In July 2022, the group prepaid 450 million of outstanding external debt at the holding company. The remaining debt of the holding company is now 550 million, falling due in May 2024. Cash at the holding company was 505 million at the end of the year. Leverage is 1.3x in June 2023, and that's broadly stable despite over £500 million of spectrum investment in the last fiscal year. and the renewal of the Spectrum license in Nigeria in the period. We go to the GAAP figures, which include the impact of the exchange rates. Revenue was up 9.6%, operating loss was up 8.7%, profit after tax was 184.7% worse off, basic earnings per share was 204% worse off, and net cash was up 49.3%. They also have on the investor relations part of the website, and this isn't, I couldn't see it covered in the earnings, but they have, I don't know if it's newly launched, so they've just started talking about it, but they've got a product called Airtel TV. And they've said innovative products such as Airtel TV have been a one-stop solution for live news updates, as well as providing entertainment, education, and empowering Airtel customers to customize their viewing experience. The Airtel TV app is subscription-free and offers registered users unlimited access to live TV, news, and then the entire Airtel TV content library. The positive response from customers makes Airtel TV one of the fastest-growing media streaming services in sub-Saharan Africa. The platform is committed to delivering high-quality content to our subscribers, giving exposure to local stories and local talent. Airtel TV is now live in 14 countries with 6.8 million registered users. I don't know what this is. It doesn't seem like they're pumping loads of money into it, so I don't really mind. If it works, that's quite nice, but it looks like it's pretty low risk. I don't think they're going to be spending the amounts that Netflix is spending, but I just thought it was interesting because I haven't seen that before. In terms of the valuation, the business trades at a P ratio of 8.39, although that doesn't include the massive hit the earnings have just taken. And the market cap is £4.28 billion, and the dividend yield is 3.79%. As an Airtel shareholder, I'm pretty happy with these results. We knew the Nigerian devaluation was coming. Hopefully it is a one-off, but we will find out. But we knew it was coming. The actual business performance is very good, and the currency is just something that's entirely out of their control. So I'm pretty happy. And yeah, I think it's pretty cheap, but I usually do. John, what are your thoughts on the results and the valuation?
Again, I thought the results were really good. We got used to them, but also it's not priced for huge growth either. Or maybe it is priced for growth, but it's just reflecting those risks, those inherent risks. And currency is, up there as one of them, and the political situation. So yeah, I'm very happy to still hold Airtel Africa, and I think growth that it's delivering and ahead of it is massive.
What do you think of the currency devaluation? Do you have any concerns about that?
I mean, it's not ideal. Of course it's not. But again, what can you do about it when you're operating in the region that you're operating in?
Fair enough. Shall we move on to a less risky business?
Yes, so Unilever, favourite of the show and in our fantasy portfolio, had their first half results out with first half revenue of €30.4 billion, reflecting underlying sales growth of 9.1%, which was ahead of expectations. Growth was entirely driven by higher prices, with volumes falling 0.2%. Underlying operating profit rose 3.3% to €5.2 billion, and inflated costs were fully offset by pricing and cost savings, which helped margins improve. Free cash flow rose by 300 million to €2.5 billion, driven by higher operating profit. Net debt at the end of the period rose by 600 million euros from the end of 2022 to 24.3 billion euros. The group expects underlying sales growth for the full year to be above 5%, with both cost inflation and price hikes to ease through the year. And the board announced a quarterly dividend of 42 cents a share, and this boosted the shares by over 5% in early trading. I thought these results were really good. We've got a good peer to compare it with, which is, Unilever being the UK's largest consumer goods company and Reckitt being the second largest. But they were significantly better than Reckitt, and you're seeing volumes drop very slightly, but nothing compared with Reckitt. I think it is a testament to the brands. We do have a new chief executive in Unilever at the moment, but I don't really think that any of these will be down to him just yet. So it'll be interesting to see where he goes and whether he can narrow the gap with Nestle. Valuation-wise, Unilever's massive. It's got a market cap of 107 billion and it trades 17 times forward earnings, which I appreciate is pricey, but it is lower than its 10-year average, which is about 19, and it has a decent dividend of around 4%. So all in all, it's a company that I really like. It's a company that I've held for a long time, and it's not a company that gives me sleepless nights. So I'm very happy just leaving my money where it is in Unilever and reinvesting the dividends. Sam, what are your thoughts on these latest figures from Unilever?
I think they're good figures. I think in the last sort of 6 months or so, they've started putting up much better figures. I think prior to that, they were putting up all right figures, but they weren't really keeping up with inflation. And then since then, they've started upping the prices more, and there's not really been a drop-off in volumes, which I think does show the power of the brands that they've got, especially compared to the Reckitt results we've just covered. I think the new CEO is interesting. Like you say, he's not really had enough time to actually make any impact, but didn't particularly rate the previous management. It was at times a bit farcical. So I think if you're getting these kinds of results now, in combination with new management, I think it does look quite encouraging, and I like it. And I mean, it's not cheap, but I don't think it's outrageously expensive either, and it's got a pretty decent dividend too.
Okay, very good. Would you consider it or watch list?
I think it's good enough for the watch list, but it'd probably have to be a lot cheaper before I considered buying it. I think just because I know it's only going to grow sort of 5 to 10% a year.
So onto a company that you prefer and you
Yes.
own.
And I
Games
own,
Workshop.
Yes. Games Workshop. They make the miniature figures, which I'm sure most people are aware of, the Warhammer. So they have come out with their full year results, and their core revenue is up 15% to 445.4 million. Their licensing revenue is down 9% to 25.4 million. The revenue at constant currency is up 7.8% to 447.3 million. Operating profit is up 8% to 170.2 million. Earnings per share is up 4.7% to 409.7 million, and dividends per share are up 45% to 415p a share. There's quite a few other bits that I want to go through in the annual report. So we basically went through this last year. They include it every year, but it's them going through their strategy part by part. And I just think it's a very, very good way to understand the business and the thinking of the management team that have put this report together. So they've said the first element of the strategy is that we make high quality miniatures. We understand that what we make may not appeal to everyone. So to recruit and retain customers, we are absolutely focused on making our models the best in the world. The second element is that we make fancy miniatures based on our endless imaginary worlds. This gives us control over the imagery and styles we use and the ownership of the IP. Aside from our core business, we are constantly looking to grow our licensing income and opportunities to use our IP in other markets. The third element is that we are customer focused. We aim to communicate in an open, fun way. Whoever and wherever our customers are, and in whichever way they want to engage with Warhammer, we will do our utmost to support them. The fourth element is the global nature of the business. Our customers can be found anywhere, and we seek them out all over the world. They're a passionate bunch with an interest in science fiction and fantasy. They're collectors, painters, model builders, gamers, book lovers, and much more. And while no two customers engage with Warhammer in exactly the same way, they're all deeply invested in the rich characters and settings of our IP. To reach them, we have two key tools, our retail chain and our digital content. In retail, we showcase a Warhammer hobby and offer a fantastic customer experience. Our digital offering has never been richer. Through warhammercommunity.com or warhammer-community.com and social media, we reach thousands of people every day, showing them the very best aspects of the Warhammer hobby and inviting them to join our global community of enthusiastic fans. The fifth element is being focused on cash. By delivering a good return every year, we can continue to innovate, surprise, and delight our loyal existing customers and new customers with great products. We measure our long-term success by seeking a high return on investment. In the short term, we measure our success on our ability to grow sales while maintaining our core operating profit margin at current levels. We have two main universe settings, our dark, gritty, fantasy sci-fi universe, which encompasses Warhammer 40,000, Warhammer the Horus Heresy, and Necromunda, and our unique fantasy setting that includes Warhammer Age of Sigmar, Blood Bowl, albeit a tongue-in-cheek parody, and the soon-to-be-released Warhammer the Old World. We believe our IP to be among the best in the world. design. They've highlighted that they design all of their products at their HQ in Nottingham, which you can visit, by the way, if you want a trip to Warhammer World, which I would recommend as a shareholder. Many customers love personalising their miniatures, and our Citadel colour paint range, brushes and accompanying painting system are designed to help everyone from the complete beginner to the most experienced painters in the world achieve great results. We're proud to manufacture our products in Nottingham, which is the centre of expertise for our global business. It's where we started and where we intend to stay. Our products is distributed from our main warehouse at our HQ, the Eurohub, or our warehouse approximately 25 minutes away. These warehouses supply our 2 hubs, one in Memphis, Tennessee, and one in Sydney, Australia. Between these 4 warehouses, we're able to directly supply our independent retailers, our own retail stores, and fulfill our online orders. Our core revenue is generated via 3 channels: our own retail, third-party independent retailers, trade, and our online store online. We also sell via our licensing partners. We support these channels and activities via our digital marketing team. Our stores only stock Games Workshop products. They are where we recruit the majority of our new customers. To do so, the stores don't offer the full range of our products, only starter sets, new release products, and the appropriate extended range. At the period end, we had 526 of our own retail stores in 23 countries. And then for trade, they've said we sell to third-party retailers under closely controlled terms and conditions. The bulk of our sales to independent retailers are made via our telesales team based in Memphis, Nottingham, and Barcelona. We have a small telesales team in Sydney, Tokyo, Shanghai, Singapore, Hong Kong, and Kuala Lumpur. In 22-23, we had 6,500 independent retailers, and that's up from 6,200 last year, and they're in 71 countries. For licensing, they said we grant licenses to a number of carefully chosen partners. This allows us to exploit our IP to broaden the presence and brand exposure of Warhammer around the world, offering and entering new markets such as media and entertainment. It also allows us to generate additional income. Currently, the majority of this income is generated by video game sales in North America, the UK, and continental Europe. It's obviously soon going to include the licensing income from the Amazon deal that was signed this year, where they're going to get in their own basically TV universe on the Amazon Prime video app. They've got 526 stores compared to 518 a year ago. The number of stores in the UK remains the same at 135. North America's increased from 165 to 172. Continental Europe has increased from 151 to 154. Australia's flat at 49, and Asia has decreased to 16. I think that's the second year of decreases in Asia, which is a bit disappointing, but it does look to be growing in North America. And if they could crack that market, that would be massive. Because at the minute, there's only about a third more stores in North America than the UK. And when you think of the size of the American market in comparison, that's got a lot of room for growth. They've also said that their first cafe store in Tokyo, which opened in December 22, has started well and has been recruiting new customers from day one. We're planning to open 3 additional Warhammer stores in other cities across Japan in 23-24. And they've also highlighted in the return on capital section, a long-term measure of our performance has been return on capital employed. During the year, our core business return on capital has increased from 118 to 133%. Return on capital employed was calculated using the period end values. It would be 155% up from 113 a year ago. In terms of the market cap, the business trades at £3.84 billion, so it is still pretty small despite the growth it's had in the last few years. It now trades at a P of 28.31, which I think, looking at these results alone in isolation, looks quite expensive. However, if you look at the international potential, the IP, the Amazon deal, and what that could do for the actual sales of the product, I think if you believe in where the business is potentially going, it's pretty cheap. But based on the growth numbers it's put up this year, it is quite expensive at this, a P of 28. I would caveat it with it had a very, very good COVID, and it's still growing on top of that, whereas there's a bit of doubt whether it could even hold on to the COVID sales. So although it's on its own not that impressive, it probably did get a lot of almost demand pulled forward as a result of COVID. And it's currently yielding 2.79%, which is quite nice, given you're probably not buying it for the income anyway. As a shareholder, I'm very happy with this. I think one of the main pluses of the year is the Amazon deal, which I haven't really gone into that much detail, but that could be massive for the brand. I think that could also massively help the North American stores if the shows are a success. So yeah, I think it's got quite an exciting future. It's expensive, but I'm very happy holding it. John, what are your thoughts as someone who doesn't hold it, but has always admired it?
Yeah, I feel, well, not that you can time the market, but whilst I was saying that I liked it and didn't pull the trigger, and yeah, it was down this sort of in this sort of £60 a share, and it's now over 116. Yeah, it's still on my watch list. I generally don't like to pay up that much for the companies, but I appreciate all of the arguments and that it is very high quality and it's got that growth potential. Well, I mean, it delivers, but it's also got that, potentially huge growth ahead of it. With North America, I know things China-wise are sort of slowing down, but internationally, and it's got a small market cap. It's not a big company, so there is, massive room for that. And like you say, or like you alluded to with Amazon, if that takes off, is very popular in the States, and then seeing how that impacts on the sale of the sort of figurines, etc., it could really be massive. So I do like it a lot. Not cheap, but you wouldn't expect it to be. So I'm watching at the moment.
Right. Should we move on to a business that historically is pretty cheap?
Yes, it is, and it remains so. Centrica, which is the owner of British Gas, had their first half results out, with first half revenue rising 60% to £16.5 billion due to higher energy prices, and helped by strong performance from the British Gas energy division. Underlying operating profit was £2.1 billion compared with £857 million last year, excluding the sale of Spirit Energy assets. Free cash flow more than doubled to £1.4 billion thanks to the increased profits. The underlying net cash position rose from £1.2 billion to £3.1 billion in the 6 months to the 30th of June. Most of the tailwinds have been felt already due to the impact of the price cap and seasonality, so Centrica expects lower underlying profits in the second half. An interim dividend of 1.3 pence a share has been proposed, which is up by a third. The existing share buyback programme has been extended by £450 million to a total of £1 billion and is set to be completed over the next 12 months. And the shares were up 4.5% in early trading. I am a long-suffering Centrica shareholder. I thought these results were really good. It's largely what we would have been expecting, although possibly slightly better. They have really struggled in the last few years, and I bought the shares maybe about 6 years ago, and that was, they were supposed to be turning things round then, only for the energy price cap to come in, which really did hammer Centrica. You had low energy prices, and then on top of which there's lots of switching going on. And Centrica, it wasn't the healthiest business, but it did rely on a lot of British Gas customers not switching and sitting on standard variable tariffs, which at that point weren't capped. And as well as the cap coming in, they were still hemorrhaging their existing customers because it wasn't capped low enough for those sort of more price-sensitive customers. So had a really, really torrid time. It looks absolutely grim over COVID when things were at rock bottom. And they previously had a lot of debt. And I think we commented previously about their pension scheme as well. Since then, and on the back of, partly on the back of the Russia situation and the rise in energy prices, it's been fantastic for Centrica. And also, when the government had intervened in the energy market with these price caps, you did see that there hadn't been much planning, there hadn't been much hedging in a lot of the smaller startups. So a lot of these competitors where people were or had been switching to went bust. So you almost went back to the position where you did have kind of big six. And Centrica inherited some, I don't know whether inherited is the right term, but acquired some customers as a supplier of last resort when some of its smaller startup competitors went under. So I think it's very interesting. It's, in terms of valuation now, it's got a market cap of 7.7 billion and it's trading at about 4 times earnings. It's incredibly cheap. It's got a decent dividend yield, which is growing, but it was cut altogether. It was 3%, but growing that, they're doing the share buyback. I think, stating the obvious, but we've seen all of the government intervention. We've seen windfall taxes. I don't think anyone likes to see a utility company like Centrica doing well, especially at times that we're in currently. So I think you would probably expect further state regulation, and particularly if Centrica kept putting up, impressive numbers, there'd be more clamour for that. So it's not a company that I would be buying any more shares in. You could be a bit more contrarian with it and seek value in it. I think if I didn't already have a position in it, I wouldn't be looking to do that now. I have just rode things, so I must have, my average purchase price of Centrica must have been around £2, maybe slightly below. And it went down all the way to about 30 pence in the depths of COVID. And now we are seeing it recovering arguably slightly more sustainably, although these things are erratic, and it's about nearly £1.40 a share now. But for a business that's looking healthier, albeit in an uncertain environment. So I think I'll just be sitting tight on it. But if I didn't own shares, I probably wouldn't be rushing to take a stake in it. Sam, what are your thoughts on the figures from Centrica and Centrica as a company, I suppose?
They are very good results. I don't think you would expect otherwise, but very, very good results. Can't knock those. But I would just never touch it because of all the reasons you've just outlined. I wouldn't. It's gone a bit quiet in the last few months because we're in summer now, so people aren't having to. No one's got the heating on. But as soon as we're back into winter, you just know what's going to happen, and it's just so politically charged, this industry. The same as like oil and gas. I just wouldn't want to own it because yes, it might be giving you very good returns as a shareholder, but you're probably not going to be allowed to enjoy them. See, I just wouldn't touch it with a barge pole because of that potential for more political intervention. I don't really have much more to say.
Okay. What do you think of all the cash? They've got about 3 billion.
I think they'd better get rid of it before someone gives them another windfall tax. I'll just do a fat dividend.
Okay, yeah. Interesting. Yeah,
that's the other thing. You can just see the articles, Poor little Johnny can't have heat in his house this winter, and they're sat on 3 billion of cash. Doesn't look good.
No, and I know they're extending the share buyback, and and the dividends are up by a third. Although the dividends, they did cut them. Well, just cut it all together. They cut it right down. I'm just looking at the chart now. It did bottom out about 31 pence. That was in April 2020. So yeah, sort of, I guess, peak COVID in that sense. But for me, it's one of those difficulties because you get anchored to certain prices, and there's a lot of psychology involved. Involved when you own the share and you've seen it go up and down. I think the other thing for me, which was unfortunate, was that Centrica, as a utility company, used to pay a fairly fat dividend. So I moved it from my general investment account into an ISA account. And then I saw the share price go from whatever it was, about £2, all the way down to 30 pence. And I couldn't even offset it. So that was quite sad. But anyway, and then I did buy it back. But, after that, outside my ISA, sort of switched a few things around, and it went all the way back up. So I think I ended up paying some capital gains on it, which is a little bit sad when you've seen it go all the way down. But I suppose you shouldn't try to gain any of that stuff with bed and ISA-ing. But anyway, back in my ISA now, and it's seen some decent growth. But anyway, that's just an aside. Shall we move on to a higher quality company then?
Yes. So our US company of the week is Visa, and they have come out with their third quarter results, and all these figures will be in dollars. Visa's third quarter revenue grew by 13% to $8.1 billion, ignoring the effect of currency movements, which was broadly in line with analyst expectations. Strongest growth was seen in cross-border volumes, excluding Europe, which were up 22%. Payment volumes growth was more muted at 9% due to a fall in US growth over the quarter. This was mainly driven by moderating inflation, which implies slower increases in the value of transactions processed by the Visa network. Underlying net profit increased at a slower rate, up 7% to 4.5 billion. As a small fall in operating expenses failed to offset an increase in the tax rate from 10.9% to 19.2%. Visa generated free cash flow of 13.1 billion, up from 12.3 billion. Net debt was 12.5 billion at the end of the period. The group bought back 3 billion worth of shares, and a dividend of 45 cents per share was announced. In terms of the valuation, business trades at a forward P of 24.9, and that compares to a 10-year average of 26.6, and the prospective yield is 0.8%. I think this is a fantastic business. It's got good results. However, there are a couple of things that concern me. The main one is the size, actually. It's growing very well, but it's probably put up similar growth figures to what we've just seen from Games Workshop. But obviously, Games Workshop is a £4 billion business, and
it's nearly half a trillion.
Half a trillion there. Yeah, 483 billion. So it's basically 100 times the size. So it's much harder for this to carry on growing. You can look at Games Workshop and make a pretty good argument for the growth accelerating. Whether it does or not, I don't know. It's hard to argue this is going to get to 10, 15, 20% growth, or get to 15, 20% growth a year and sustain it. And they're priced pretty much the same in the mid to late 20s. I think Visa at 25 times earnings, it's very expensive. You're hardly getting any dividend. I know you're getting buybacks, but then, the buybacks are all right, actually, at 3%. About 0.6% of the market cap is getting bought back. Is that a quarter? So it's not loads, but you are in total getting a few percent, same as Games Workshop. But I think Games Workshop has a lot more growth ahead of it. I think Visa is a very good business, but it's just really expensive. And it is in what's becoming an increasingly competitive industry. That payment space has got a lot of competitors now. So yeah, I like the business. There's probably a price at which I would seriously consider it, but at the mid-20s, it would have to probably get cut in half before I became interested. John, what are your thoughts?
Quite similar. I do really like it. Incredibly high quality. But then there are always those fears and, really fierce competition. And it's the biggest player in that market. So I don't know. Maybe. I'm sure I've got a decent amount in one of my trackers, but paying up that much as some of these companies, and MasterCard would be the other one. I don't know how comfortable I feel, but yeah, you can't knock the historical performance of it.
No, you can't. So, of the 6 businesses we've covered this week, Reckitt Benckiser, Airtel Africa, Unilever, Games Workshop, Centrica, and Visa. If you had to buy one, which one would it be? Oh, and then also, which one do you like the least?
I would, despite liking Games Workshop, I'd stick with Airtel Africa. And it's quite an easy one, which I like least. It is one I own, which is Centrica.
It's probably telling you something.
It is. But like I say, it would have been easy to sell out at the, I suppose, 30 Fed. So it is difficult psychologically when you've held it for that long.
Okay. Mine would be Airtel Africa, probably number 1. That's mainly a valuation thing. I do like Airtel Africa, but obviously at 9 times earnings compared to Games Workshop's 28, I think it just is better value. My least favourite would be Centrica as well. I just, due to the politicisation of that industry, I just wouldn't touch it.
Yeah, fine. Well, on that note, I think we'll end. And we've got earnings season continuing, so plenty of big companies for you next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.